This is Taking Stock on Bloomberg. I'm Pimm Fox. All right, so you want dividend-paying stocks, and you'd also like to participate perhaps in a little capital appreciation? Well, let's go to an expert. We've got Cliff Remily of Thornburg Investment Income Builder Fund. Cliff Remily, good to have you with us on Bloomberg.
Thank you. Happy to be here.
Cliff, just outline the strategy for the Income Builder Fund, because I want to get to Coca-Cola, but what's your strategy? How do you decide what goes into the fund's portfolio?
Well, there's three goals that we're looking for. First, we really want to have a current income that's attractive. Second, we want to have a growth in that income. And third, we definitely want capital appreciation. So those are the three goals that we're looking for in the Thornburg Investment Income Builder.
All right. Well, when you look at this idea of attractive income, I took a look at Coca-Cola. I mean, we're talking about a yield of about 3%. So what do you have to do? Kind of figure out after tax whether that's better or worse than, let's say, the yield on the 10-year U.S. Treasury?
Well, as a matter of fact, on an after-tax basis, if you assume a 35% marginal tax rate, for instance, on interest income from the 10-year Treasury, the Coca-Cola is a higher yield. But we actually look at things more of an absolute potential basis of where that yield could go, kind of like on a yield on cost. So 5 years from now, what could that yield be?
So what do you think that yield could be 5 years from now for Coca-Cola?
Well, if you buy it today at a 3.1% yield and you get something like a 5 to 7% growth rate, you're looking at like a 5% yield on cost, which gets very attractive for someone on a fixed income that is looking for growing income that can produce over time. And that's really one of the cruxes of the investment.
Talking about this idea of growing, what about growing income from emerging markets when it comes to Coca-Cola?
Well, 80% of the earnings from Coca-Cola are actually international, and 40% of that is emerging markets. And that's really where the most attractive growth is coming from, places such as Brazil, Mexico, and certainly China in the most recent years.
Do you expect any share buybacks, Cliff?
You know, we're factoring in about a 1 to 2% share buybacks. However, it's very possible that could surprise to the upside. The company is a cash flow king. It generates so much cash flow, and the management have proven to be so good at allocating capital that over the past decade, one of the interesting facts is that they've invested about $20 billion into the business. That's in capital expenditures and acquisitions, but they've taken out $32 billion and returned that to shareholders via dividends and buybacks.
Let's turn your attention now. Let's move away from Coca-Cola. I want to get your thoughts on an oil giant, BP. What about their ability to allocate capital?
BP's got to be one of the best allocators of capital in the energy space. For a space that's known to be very good at destroying capital over time, BP is absolutely not that. Again, kind of looking at a long-term average, they've spent about $116 billion on finding and developing reserves, but they've also returned $118 billion. That's $2 billion more over the same period doing the share buybacks and dividends. This is a company that's proven that they can increase reserves and give you production today. In fact, the reserve replacement ratio has been over 100% for the past 17 years.
Now, they've got a 6% yield right now. What about the risk to that, Cliff? Maybe it's political risk because they got big operations in Russia.
Well, what I like about BP versus some of the other ones is they take kind of a barbell approach to political risk. Almost a quarter of their earnings is in Russia, but the other quarter is in the USA. So it's kind of on either end of the spectrum. So yes, they have some political risk in Russia. However, it's been working out well. The project is called TNK BP, and they've been getting about $6 billion a year in dividend income. And so we don't see too much of a trouble there. However, it is something that we do factor into it.